Glad you're here. I'm Professor Don Bush. I've been teaching accounting for about 30 years, been a CPA for about that long, and I've got great ways to explain accounting, ways that you'll understand. So today's lesson is financial accounting. It's just basic accounting. It's a lesson that you probably would see in your first or second week of accounting. So I'll explain how to do it. So what we're doing here, we're working with Fred's Snowblower Service, a company in Colorado. This is based on a true story, but the name's been changed to protect the innocent. So what we're going to do is we are going to take Fred's financial information, all these accounts and amounts here, plus a little extra information right here, and we are going to turn those into financial statements. So we're going to learn a lot today. So we'll get cracking here. All of these accounts can be divided up into 5 different categories. We've got assets, liabilities, equity, revenues, and expenses. There's only 5 different types of accounts. That is it. And what we need to do is divide these accounts up into those categories. That's our first step. For instance, I got the first one done here for us. Inventory. Inventory is a nice thing to have. And in introductory accounting, nice things to have, those are usually assets. So it's kind of a rough definition of an asset. Nice thing to have. Now, why is inventory a nice thing to have? Well, Fred sells snowblowers and he repairs snowblowers, so he needs an inventory. How can he sell snowblowers without an inventory? So he needs an inventory, and this is a nice thing to have. So we'll call that an asset. Accounts receivable, that's when people owe you money, and it's a heck of a lot nicer than when you owe them money. So we'll say this is a nice thing to have too. So we'll call that an asset. Cash, who doesn't like cash? So that is a nice thing to have. There we go. Now accounts payable, that's when you owe other people money. And so we call that a liability. It's a bill. Sales revenue, well, the name gives it away. It's a revenue account. And revenue, you can only claim revenue when you do your job. You can only claim revenue when you do your work. It's really, really important that you know that. You can only claim revenue after you have done your work. All right. Common stock. Common stock is a part of equity. It represents the owner's share of the business. So the best way to define equity is the accounting equation. And the accounting equation is assets equals liabilities plus equity. Assets equals liability plus equity. So if we rearrange that just a little bit, we get a good definition of equity. And that is assets minus liabilities equals equity. That's the best way to describe it. Building. It's nice to have a building. That's a nice thing to have. That's an asset. Advertising expense. The name gives it away. That's an expense. And an expense is the cost of doing our job. And in Fred's case, the cost of repairing and selling snowblowers. And rent expense, the name gives that away too. It's an expense. Office supplies. Now, I'm not talking about office supplies expense, which is right below. In fact, why don't we take care of that office supplies expense? That name gives it away there, doesn't it? Expenses are a cost of doing business. But what about these office supplies? Now, these office supplies, that is very much like inventory. In fact, oftentimes it's called office supplies inventory. So this is probably paper and pens and staples and printer, toner, and ink and all kinds of office supplies. Maybe business forms, business cards, possibly. So office supplies, it's like an inventory. It's a nice thing to have. So it's an asset. Salaries expense, the name gives it away. It's a cost of doing business. And retained earnings is a part of equity. And that might be a little confusing right now, but it's a part of equity. It's part of the ownership interest in the business. So here we go. And the last one, tax expense. Tax expense, that is a cost of doing business here. And we've got a little bit more information here. Beginning common stock was $55,000. Now, why is that important? At the beginning of the year, common stock was $55,000. But if we look right up here, common stock is now $65,000. Well, what happened here is Fred, at the very beginning of the year, had invested $55,000 into his business. And by the end of the year, he had invested another $10,000, so he has a grand total of $65,000 that he has invested into the business. So we'll see how that works out. Dividends paid. So Fred paid himself some dividends, and all what dividends are is just owner withdraws out of the business. In corporations, we call them dividends. Withdraws, dividends, same thing. So coming down to the financial statements, and I'll have to split the screen here a little bit in order to see everything. I think I'll split it right about there. So here we go with the financial statements, and the very first financial statement we're going to do is over here on the left. Now it's very important to do these financial statements in order. In fact, you can't do them out of order. Even if a textbook problem asks you to do them out of order, you can't do them out of order. And I don't know why some textbooks do that. They should ask to do them in the right order. So here we go. Fred Snowblower Service. The first one is an income statement. Now there's only two things that go on this income statement: revenue and expenses. Revenue is money coming in from doing your job. And in this case, it's Fred selling snowblowers. And expenses is money going out from doing your job. In this case, selling snowblowers. So it's really a picture of how Fred is doing selling snowblowers. So let's see. So sales revenue, $1,450,000. So where did that come from? It came from our chart up above. There it is. Sales revenue, $1,450,000. Just put it right there. And then next we list our expenses. And the expenses here's advertising, 160. So we write that down. Rent expense for 52. Office supplies for office supplies expense for $14,000, and salaries expense for $950,000. There we go. And coming down the list here, salary. Let's see here, tax expense. There you are, tax expense, $78,000. And lastly, what we do is we add up all our expenses to get a subtotal. So all you got to do is add this up. And if you're doing this on Excel, it's real easy. I hope that you're doing your homework on Excel. It is so much easier, and you probably won't be making silly, goofy math mistakes. So here we go. So our total expenses are $1,254,000. And net income, $196,000. How do we get that? Well, you just take your total revenue here. Here's our revenue, minus away your total expenses, and you get net income. So there you go. Now, I highlighted this net income in this beautiful blue color because it reminds me of the beautiful Columbia River up in Oregon. I grew up in Oregon and used to hang out at the Columbia River quite often, and it's really a big, beautiful river. And the river flows in only one direction. It flows downhill, and it flows from Idaho to the ocean. And the whole time I lived in Oregon growing up, I never saw the Columbia River go the other way. I'm sure that would make news headlines if it did, but never once did the river go the opposite way. And in accounting, it works the same way, that this net income is like part of the river. The river flows to the next step. Look at this. So net income, 196, it just flows over here to the next step. So add net income, 196,000. So if you're wondering where this 196,000 come from on this next statement, well, it came from the income statement, and that is why you have to do these statements in order. So the next statement here in a green color, this is a very simplified version, but it works and it's good, and all the small businesses that I know of, this is the way they do it. So it's called the Statement of Changes in Retained Earnings. And retained earnings, it might be a concept that you don't fully understand at this point, but it's okay. Right now, it just represents the equity in the business. So beginning retained earnings, $291,000. Where'd we get that? Right off the chart. We add the net income, which flowed over like a river over here, $196,000. Less dividends, $35,000. So where do we get the dividends? It came from this other information right here. $35,000. There it is. So we're going to subtract out the dividends, and whatever's left over, we have ending retained earnings. So 291 plus 196 minus 35 is 452,000. Now I put ending retained earnings in blue because it also flows like a river. It flows down to the next statement. Now, I hope this doesn't confuse anybody, but we did a good job here on the statement of retained earnings. It's fabulous. It's just the way it should look. But some textbooks teach this alternative format. And large businesses like Apple Computer and Microsoft and Amazon.com, they use this alternative format. Little businesses use the other format. So all we're doing is we're just doing what we did here in this green statement, but we're doing it this other way in case your book teaches it this way, just so you don't get mixed up. So here's the alternative format. Now it looks kind of confusing and it looks scary and everything, but it isn't. In fact, we already know how to do half of it. This retained earnings column right here, we already know how to do it. In fact, if you take the numbers off of what we did originally, right here, and just transfer them down to this pink statement, this alternative format, we have the same thing. So let's check it out. Let's look at this retained earnings column. Beginning balance, 291. Again, that came right off the chart. There it is, 291. Add the net income. That came from, like the river, off the net income, off the income statement. There we go, 196. Minus the dividends. The dividends came from the notes, right there, dividends. We get 452,000, and that's exactly what we came up with before. There we go. So half of this thing is exactly what we've been doing anyways. So what's the difference? Well, the difference is this common stock right here. So the beginning balance in common stock, we get it right here from the notes. Beginning common stock, 55,000, put it right there. And the ending common stock balance was 65,000. How do I know that? Well, I got that right off the chart, right here. Common stock, 65,000. So there's the ending balance. So, and we don't do anything with dividends right here. We just leave that blank. So we've got 55 here to begin with, 65 to end with. So we must have issued common stock, $10,000. So that's how we figure out the $10,000. And finally, the total column over here, all we do for all of these totals is we just add up horizontally. What I mean is, how do we get this 346,000? Well, it's 55,000 plus 291 equals 346. How do we get the 10,000? Well, 10,000 plus 0 is 10,000. How do we get the 196? Well, 0 plus 196 is 196, and so on and so forth. So you just add horizontally. So there you are. So these ending balances, like this 452, here I've got it in blue, and it's in blue right here too. It's part of the river. It's going to flow to the next statement. In fact, I've got it listed down here where it flows to. So that's how the river ends up. So you have to do these financial statements in order, or it won't work. All right, so folks, so all we got to do here is fill out this balance sheet and we are done. And I love the balance sheet. It's one of my favorite statements here, folks. And all what the balance sheet is just the accounting equation. It's assets equals liabilities plus stockholders' equity. That's all it is. It's just the accounting equation. So here you go. All you do for assets is we just write down what all the assets are. For instance, cash, 25,000, accounts receivable, 58,000, and inventory, 125,000. Now these are listed in this order on purpose because they're listed in order of liquidity. Cash is the most liquid of assets. Liquid means you can spend it really fast. And accounts receivable, that's where people owe you money, so hopefully they'll pay you up soon. Inventory, well, in order to get the money there, you got to first sell what you have, and then customers have to pay you before it's turned into cash. So this is in order of liquidity. And office supplies, we're going to use those up. We don't plan on turning those into cash. And the building, we need our building. If we don't have our building, we don't have much of a business here, so we won't be selling that. So the order of the assets is done on purpose. But anyways, the numbers are really easy. They just come off the information. There we go. There's the building, 350,000. Boom. And then what you do is you add up the assets. So if you're doing this on Excel, it's really easy. Just get a total here. 562,000. Now, liabilities. Liabilities are bills that are owed, money that is owed, and there was only one right here off the chart. Liability, there we go. Accounts payable, 45,000. So you just put it there. And I don't have a subtotal here because there's only one of them. Coming down here to common stock and retained earnings, stockholders' equity. So common stock, 65,000. We get that right off the chart. Now retained earnings, we can't take that off the chart, but what we have to do is take advantage of the river here, how it flows. There it is. 452 for retained earnings. Or if you want to take it off of this chart, 452. There you go, 452. So retained earnings is 452, so it flows right down here, 452. Total stockholders' equity is 517,000. All you do is add this up, 517,000. Now, this last step, you got to do this. Don't drop the football on the 2-yard line here. You're almost done. But it's important to have this last line, total liabilities and stockholders' equity. For some reason, students forget to do this. And so what you do is you take your total liabilities, add up your total stockholders' equity, and in this case, we get 562,000, and then you double check and you say, well, is that the same as my assets? Because assets equals liabilities plus owner's equity. And this is where we've proved it to be equal. And if your problem in your homework equals, then you did a good job. You probably did it right. So hope this lesson helped you guys out. And if you like this lesson, let me know. Make a comment down below. Hit the like button. Do something here so I know that these lessons are helping you out, and I'll make some more for you if you'll let me know. So talk to you later.